Hello everyone and welcome back. We have explored the consumer side of the market with demand. Now we are flipping our perspective to look at the producers and sellers. In this video, we will introduce the concept of supply. We will define what it is, establish the fundamental law of supply, and learn how to draw and interpret a supply curve. This is the second critical piece of the market puzzle. Let's begin. Just like demand, supply has a precise economic meaning. Supply is the quantity of a good or service that firms are willing and able to produce and sell at various prices over a certain period of time. Again, the keywords are willing and able. A company might be able to produce 1 million smartphones, but if the market price is too low to make a profit, they won't be willing to do so. Both conditions must be met for there to be supply. We can represent this relationship in a supply schedule, a table, and a supply curve, a graph. Let's stick with our coffee example, but this time from the perspective of a cafe owner. The law of supply establishes a fundamental principle. There is a positive direct relationship between price and quantity supplied. When prices rise, producers respond by offering greater quantities of goods to the market. Conversely, when prices fall, the quantity supplied decreases as production becomes less attractive. This relationship is driven by the profit motive, the primary incentive for firms to produce goods. Higher prices mean greater potential profits per unit sold, encouraging producers to allocate more resources toward production and bring additional units to market. The supply curve has an upward slope. The curve rises from left to right, reflecting the positive relationship between price and quantity supplied. Every point matters. Each coordinate represents a specific price-quantity combination where producers are willing and able to supply. Visual clarity. The graphical format makes it easy to see how supply responds to price changes across the entire range. Movement along the supply curve. Extension in supply, which means increase in quantity supplied. When the price of the good rises, producers move up along the existing supply curve, offering a larger quantity to the market. This is called an extension of supply. Contraction in supply, which means decrease in quantity supplied. When the price of the good falls, producers move down along the existing supply curve, offering a smaller quantity. This is called a contraction of supply. Critical IB distinction. Movements along the supply curve are caused only by changes in the price of the good itself. The curve itself doesn't shift. You simply move to a different point on the existing curve. This is fundamentally different from a shift of the entire supply curve, which we will explore in the next video. Let's see now why the producers respond to the price changes. First, profit opportunity recognition. Higher prices signal increased profit potential per unit sold, capturing producer attention. Second, resource allocation decision. Producers evaluate whether to dedicate more resources, labor, and capital to production. Third, production expansion. Firms increase output levels, potentially adding shifts, hiring workers, or utilizing spare capacity. Fourth, market supply increases. Greater quantities reach the market as individual producers collectively respond to price incentives. The supply response isn't instantaneous. It takes time for producers to adjust production levels. In the short run, firms may have limited flexibility due to fixed capacity constraints. However, the profit motive consistently drives producers toward optimal output levels that maximize returns given current market prices. Let's do a review on our key terminology. Supply, the willingness and ability of producers to offer goods for sale at various prices during a specific time period. Law of supply, the positive relationship between price and quantity supplied. As price increases, quantity supplied increases. Supply curve, the graphical representation of the supply relationship, typically sloping upward from left to right. Movement along supply, extension or contraction in quantity supplied caused exclusively by a change in the goods' own price. Profit motive, the fundamental incentive driving producer behavior seeking to maximize returns from production and sales. Supply schedule, a table showing the specific quantities producers will supply at each possible price point. Let's summarize the supply side. Supply is the willingness and ability of firms to produce and sell a good at a certain price. The law of supply states there's a direct positive relationship between price and quantity supplied driven by the profit motive. This is shown by an upward sloping supply curve. A change in the goods own price causes a movement along the curve, an extension or contraction. We now have both building blocks of the market, demand representing consumers and supply representing producers. Thanks for watching. In our next video, we will explore what causes the entire supply curve to shift. After that, we will bring demand and supply together to see how market equilibrium is formed. If you found this helpful, please like and subscribe. See you then.